staring at the screen in a dark room. You watch a small dip turn into a slide, then a free fall. The numbers tick down, and your pulse starts to race as the screen turns a deeper shade of red. There is a well-known statistic in this industry. 90% of day traders will fail to make money. According to this text, these failures are almost entirely the result of one specific oversight, an inability to manage risk. Many of these people aren't using bad strategies. They understand moving averages, they spot the trends, and they have the right indicators. The failure isn't in the plan, it's in the emotional human being executing it under pressure. To understand why a profitable system collapses, we have to look past the strategy and examine the exact moment a trade turns negative. That is where the psychological trap snaps shut. It starts with two primary emotional triggers: the fear of loss and the fear of missing out. These instincts prevent a trader from accepting a standard 10-cent loss. Instead of treating it as a business expense, they treat it as a personal defeat they need to fix immediately. This is what the industry calls a snowball day. As the source describes, this is when a trader goes into the red and instead of walking away, they average down or get extremely aggressive in an attempt to claw back their capital. They stop following their plan. They ignore their stop losses and start swinging for the fences on any stock that moves. They increase their position sizes far beyond their limits, hoping one massive win will wipe away the day's mistakes. This emotional spiral has a predictable end. What should have been a minor, manageable loss turns into the total depletion of the trading account. The market didn't take that money. The market is just a sequence of data points. The trader handed their capital over because they prioritized protecting their ego over protecting their account. Think of trading like skiing. You go into it knowing that falling is inevitable. Success isn't about avoiding the fall. It's about learning to fall in a controlled way so you don't get hurt. Professionals practice what's called trading from the couch. They treat their own internal reactions, the sudden greed or the flash of anger, as market data. They acknowledge the impulse but refuse to let it move their finger on the mouse. An amateur reacts to a moving average cross because they're afraid of missing the move. A professional uses those same moving averages merely as a structural filter. If the price doesn't hold the channel, there is no trade, period. In this environment, inaction is a skill. The goal is to wait until the market aligns with your rules, rather than trying to force the market to align with your needs. This visualization shows the first layer of a disciplined trade: permission. When the price consistently holds above this moving average channel, the trend is up. This tells the trader they are only allowed to look for buy signals. Once you have permission, you wait for precision. You watch for a pullback into the channel. Only when the price reclaims its strength and the momentum histogram turns green do you execute. Then the math takes over. The survival rule is absolute. Never risk more than 1% of your account on a single setup. If you have a $100,000 account, your maximum risk is $1,000. This source emphasizes the need to cap your losses. You set a hard stop loss where your trade idea is proven wrong. You don't negotiate with it, and you don't move it. You take the 10-cent loss and move on. These rules don't guarantee that every trade will be a winner. Instead, they ensure that your losses remain small enough to be statistically irrelevant, allowing the probability of your strategy to play out over time. This is the reality of a career trader. The room is quiet, the decisions are methodical, there is no physical tension, even when the market moves against them. They enter a trade according to their rules. A minute later, the price reverses sharply and hits their stop loss. There is no anger and no urge to get even. The system closes the trade automatically. The capital is protected, and the trader views the loss as nothing more than the simple cost of doing business. They log the trade, note the exit, and return to a state of neutral observation. They aren't chasing a jackpot. They are managing a process. A trading strategy is like a gym program. It works on paper, but it only produces results if you have the discipline to follow the rules when you're tired, frustrated, or bored. Long-term success requires a total detachment from the outcome of any single trade. When you stop caring about being right on every move, you finally have the freedom to be profitable. Because ultimately, trading में success strategy से नहीं, mindset से आता है.